Assalamu alaikum friends. Due to the time pressure, I am recording this chapter as lectures in video form. So this chapter actually discusses the accounting issues related to the receivables, accounts receivable, which is current assets. So it's not only restricted to accounts receivable, there are other types of receivables as well. So we will discuss what they are. And of course, receivable is uh, belongs to the asset family, which is known as a financial asset, right? So if you will look for the definition of the financial assets, so these are the assets which do not have any inherent value, just like furniture or equipment. So furniture, equipment, inventory, supplies, these are the assets which have their own inherent utility. But financial assets do not have their own inherent utility. So they are sort of claims. So that's why account receivable is also a claim on somebody for money for services rendered or things like that. So the first thing is about the types of receivables. So the receivables which have been mentioned here, which are covered in our syllabus, are the accounts receivable, which are the amounts customers owe to the account on account. So they result from the sale of goods or rendering of services. So whenever we sell goods on credit or we render some services on credit, then we debit the asset which is known as account receivable. There are notes receivable, which are a written promise as evidenced by a formal instrument for amounts to be received. They normally requires a collection of interest and extends for time period of 60 to 90 days or longer, or maybe shorter. And both are receivables that result from sale transactions are often called trade receivables. So notes receivable are actually formally documented credit instruments, whereas account receivable are usually known as open credit. So trade receivables and account receivable, although they identify over here as different receivables, but generally in the context of Pakistan, they are the same receivables. So trade receivables or account receivable usually are the open receivables, open credit. It means there is no sort of a legally binding document that exists between the parties. There is a note receivable. There is a sort of a promissory note on which a stamp duty is paid, and the witness is also signed. So it's a more legally formally executable document, right? So note receivable and account receivable can be converted to note receivable, right? If it is legally, if it is formally documented, it becomes a note receivable. And usually in the West, whenever note receivable are there, they carry some interest. Number one, right, for the credit time period, and number two, they have a very limited time period, usually 60 to 90 days, or maybe a little bit more or less. And there are other receivables as well, for example, which are not trade receivables. So the example they say is interest receivables, loans to company officer, advances to employees, and income taxes receivable from the government, income tax refundable. So these are usually these accounts are titled accordingly. But sometimes you will see even in Pakistani annual reports companies that there will be some other receivables, and the notes corresponding to other receivables, you will be able to see the details of the receivables. So next we discuss the recognizing account receivable in the next video. Thank you. Okay friends, so recognizing accounts receivables, uh, it says that a service organization records a receivable when it performs service on account. So when the service is actually performed, it is completely delivered, then we record the service revenue. If we have seen in chapter 3 that if a service extends more than one accounting period, then at the end of the accounting period we record an adjusting entry for the amount of service, the dollar amount of service that has been delivered. For example, if I have taken a service contract for delivering services for 6 months, so probably I will invoice the client after 6 months. But every month end, I will record an adjusting entry for the amount of service that has already been delivered and the receivable that has already been created. So this is the adjusting entry: account receivable, debit, and service revenue credit. And this is the actual entry as well when we raise the invoice. So the entry is quite clear: account receivable, debit, and service revenues credit. And when it is the selling of goods, so we have seen in chapter number 5 that when the goods actually, when the risk and rewards of the goods pass on to the buyer, then actually the sale is recorded. So it says that the merchandise records account receivable at the point of sale. So what's the point of sale? It depends on the terms of shipment, as we studied in chapter 5. If the terms of shipment are FOB Karachi port, for example, Then whenever the goods reach Karachi port, the ownership, the risk and reward transfer to the buyer. So the sale takes place at Karachi port. If the terms of shipment are FOB Lahore port, then the sale will be recorded when the goods reach Lahore port. So when the goods are being dispatched from Karachi, they are still my goods. There is still no sale if I am the seller in Karachi, for example, and if the buyer is in Lahore. So the terms of shipment actually define when the sale is supposed to be recorded, and whenever the sale is recorded, the corresponding entry for cost of goods sold to inventory is also recorded if the company is using perpetual inventory system, right? So this is something we have already discussed in chapter 5. So the timing is dependent on the terms of shipment, right? So coming on to the entries, so the entries are quite simple. Account receivable is debited, sale revenue is credited, and corresponding entry for, say, the cost of goods sold as well, if it is a perpetual inventory system. And now on July 5, the customer returns some of the goods, so account receivable has been reduced because the goods have been returned. So now the amount that is receivable has come down by 100, and sales revenue was credited in the original sales, so sales revenue has to be debited or reduce the sales. But as we discussed in chapter 5, that we create a contra revenue account, sales returns and allowances, with a debit against the sales revenue credit. So sales returns and allowances has been debited, account receivable has been credited, and eventually when the customer pays within 10 days, because the terms of shipment in this example were the payment terms were 2 by 10 and by 30, so 2% discount paid within 10 days. So 1st July, 11 July, within 10 days has been paid, so 2% discount. So the original sale was 1000, the return was 100, so the outstanding balance was 900. 2% of 900 is 18, right? So we'll get 882. This is the cash debit. Sales discount, again this is a contra revenue, so this is debit, and account receivable credit. So the complete account receivable has been now set off against discount and cash. So this is the complete cycle. Over here, the author discusses that sometimes if there is interest revenue is also there. Interest is also part of the terms and conditions, that if you don't pay, if the customer don't pay within a certain time, the customer also has to pay a certain amount of interest. So for example, that interest is also due, so we increase the account receivable and we credit the interest revenue. So interest revenue is another sort of an income. So an income is, whenever increase is recorded as a credit, so account receivable has increased. If in this particular example you can see that original account receivable was 300, when the customer didn't pay in time, so a further $4.5 has to be debited in account receivable, and the customer now will pay interest as well. So the total receivable will be 304.5, and the 4.5, where it is coming from, it is a revenue. Then there are some case studies which you can see, and there are some more entries and examples which you can see. And the next video we shall see the valuation and disposition of account receivable. Thank you.